currency and commodity markets continue to ponder whether they will get the dream scenario of a cooling in inflation, a soft economic landing and interest rate cuts from central bankers. Policymakers continue to watch inflation and unemployment as key indicators, even if both sets of data are lagging and, in the case of the jobs figures, prone to revision, especially in America. The Bureau of Labour Statistics has just revised down its estimate for US job creation in the past year by more than 800,000 jobs, or a quarter of the total it originally thought had been added. That combination of backward-looking figures and revisions to them only increases the risk that central bankers and investors are led up the garden path by these macroeconomic data sets, but financial markets pay slavish attention to the jobs figures all the same, and we're due the latest batch from America in the coming week. The headline numbers to watch will be as follows. Wednesday the 4th of September will bring the monthly Job Openings and Labour Turnover Survey, or JOLTS. The last reading showed 8.2 million vacancies in America, up from April's low of 7.9 million, but way down from the 12 million plus peak of 2 years ago, and almost back to the pre-pandemic levels. To some, this suggests the American economy is slackening. To others, the number of vacancies is still historically pretty high. Thursday the 5th of September may bring the most reliable and timely dataset, the initial weekly unemployment claims figure. This has been chugging along consistently below 250,000 a week in the wake of the pandemic. Any spike here could signal that a hard economic landing is coming, although that's not market's expectation right now and isn't showing up in the data. Finally, Friday the 6th of September will see the release of the latest monthly non-farm payrolls, unemployment and wage growth figures. America added a lower than expected 114,000 jobs or payrolls in July to encourage those hopes for an interest rate cut. That's the benchmark for the August figure, but watch out again for any revisions to the historic data. Downward changes to preliminary estimates tend to portend of a slowdown or even a recession. Upward changes of ongoing strong economic growth. As a result of that weak payrolls number, the headline unemployment rate reached 4.3%, up from 2023's trough of 3.4%. That's still a historically low figure, but it's a big increase, and the Fed did cut when the jobless rate was around this level in 2001 and 2020, albeit then in response to the collapse of the technology stock market bubble and the pandemic respectively. Meanwhile, July saw wage growth cool to 3.6% year on year, another potential point to suggest that the Fed finally has room to start lowering the headline cost of money, as it's hinted it may do in September. Sometimes though, corporate commentary can be more timely and more useful than the macro stuff, so the week ahead could also be noteworthy thanks to FTSE 100 member Ashtead. The equipment rental specialist is scheduled to release its first quarter figures for the fiscal year to April 2025 on Tuesday the 3rd of September. Now, shares in the plant and equipment hire specialist are yet to recapture their peak of summer 2021, and they're broadly flat over the past year, to perhaps reflect residual fears of an American economic slowdown. Ashtead gets around 85% of its sales and more than 90% of its profits from its American Sunbelt operation, with the bulk of the rest coming from Canada and the A-plant business here in the UK. In this context, the soggy readings from the monthly Manufacturing Purchasing Managers Index, or PMI, from the Institute of Supply Management, or ISM, could be important. That indicator's coming below 50 on 20 occasions in the past 21 months, to suggest the American economy may not quite be firing on all cylinders, or at least that it's relying on private consumption and consumers to do the heavy lifting. Ashtead did actually cough up a couple of mild profit warnings in its last fiscal year, though Chief Executive Bernard Horgan cited lower demand thanks to the actors and writers strikes in Hollywood and a quiet hurricane season in America, rather than a more general economic malaise. The benchmark for these first quarter results will be the guidance provided by Mr. Horgan alongside June's full year figures, when he steered analysts to expect revenue growth of between 5 and 8% for Ashtead in fiscal 2025 at constant exchange rates. For the first quarter, the analyst consensus is for sales of $2.8 billion, a 3% increase on a year ago. Now that does represent a big slowdown from the 12% underlying growth achieved group-wide across all of fiscal 2024, and that may explain why the capital expenditure budget's a bit lower too. Generally speaking, the more optimistic Ashtead's managers feel, the more kit they'll buy so they can hire it out. But Mr. Horgan's initial guidance for 2025 of $3 to $3.3 billion compared to last year's spending of $4.3 billion. Finally, shareholders will look out for any comment on rumours that the FTSE 100 member is considering a switch and its stock market listing to New York from London. I hope that you and your families are all keeping well. Thank you for watching. and I look forward to seeing you again next time.